Getting ready for the Safe Mortgage Loan Originator exam? Ethics plays a big role on the test and in your career. In this video, we'll cover steering and redlining, fraud and misrepresentation, and ethical advertising practices. And don't miss what's happening in the lower corner. We'll explain that in just a minute. Now, let's get started.
Let's start with a review of core ethical principles, beginning with fairness, honesty, and integrity in lending. Which of the following best exemplifies fairness in lending practices? Is it A, offering lower rates to preferred customers, B, charging higher fees to high-risk borrowers, C, providing equal credit opportunities to all qualified applicants, or D, requiring additional documentation from minority applicants? The answer is C, providing equal credit opportunities to all qualified applicants. Fairness in lending involves providing equal access to credit for all applicants, regardless of race, gender, or other discriminatory factors, ensuring a level playing field. What is a key aspect of honesty in lending? Is it A, offering loans with hidden fees, B, clearly explaining all loan terms to the borrower, C, advertising only the lowest possible rates, or D, encouraging borrowers to sign quickly? The answer is B, clearly explaining all loan terms to the borrower. Honesty in lending requires full disclosure of all terms, conditions, and costs associated with a loan, ensuring borrowers are fully informed.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Integrity in lending is best demonstrated by: is it A, maximizing profits through aggressive sales tactics, B, ignoring regulatory guidelines to expedite processes, C, offering loans only to high-income individuals, or D, adhering to ethical standards and regulatory requirements? The answer is D, adhering to ethical standards and regulatory requirements. Integrity involves adhering to ethical principles and regulatory standards, ensuring that all lending practices are legal, transparent, and fair to all parties involved. How can a lender demonstrate fairness when assessing loan applications? Is it A, applying consistent criteria to all applicants, B, favoring applicants from certain demographics, C, prioritizing applications from long-term customers, or D, offering special terms to friends and family? The answer is A, applying consistent criteria to all applicants. Using objective criteria ensures that all applicants are evaluated based on consistent and non-discriminatory factors, promoting fairness in the lending process. Which action reflects a lack of integrity in lending? Is it A, providing clear and accurate loan information, B, following all legal and regulatory requirements, C, misleading borrowers into signing unfavorable terms, or D, offering competitive rates to all qualified applicants? The answer is C, misleading borrowers into signing unfavorable terms. Misleading borrowers into signing unfavorable terms violates integrity as it involves deception and exploitation, undermining trust in the lending relationship. Duty to borrowers and lenders. What is the primary ethical duty of a mortgage professional towards borrowers? Is it A, to provide clear and accurate information about loan terms, B, to maximize the lender's profit, C, to expedite the loan approval process, or D, to minimize paperwork for the borrower? The answer is A, to provide clear and accurate information about loan terms. Mortgage professionals must prioritize the needs and best interests of borrowers by providing accurate information and ensuring they understand the terms of their loan agreements. Which action would violate a mortgage professional's duty to a lender? Is it A, informing the lender of all borrower documentation, B, concealing a borrower's financial difficulties, C, recommending a loan that fits the borrower's needs, or D, ensuring timely communication with the lender? The answer is B, concealing a borrower's financial difficulties. Failing to disclose a borrower's financial difficulties can lead to risky lending practices, harming the lender's interests and violating ethical obligations. How should a mortgage professional manage conflicts of interest between borrowers and lenders? Is it A, prioritize the lender's interests, B, ignore conflicts to expedite the process, C, seek advice from a legal professional, or D, disclose conflicts to both parties transparently? The answer is D, disclose conflicts to both parties transparently. Ethical standards require transparency and disclosure of any conflicts of interest to ensure informed decisions by all parties involved. What is an ethical responsibility of mortgage professionals when advising borrowers about loan products? Is it A, to recommend the most profitable loan for the lender, B, to limit options to simplify decision-making, C, to explain all available loan options and their consequences, or D, to focus solely on the borrower's current financial status? The answer is C, to explain all available loan options and their consequences. Professionals must ensure borrowers are aware of all options and understand the implications, fostering informed decisions and protecting borrower interests. In the context of mortgage ethics, what does fiduciary duty imply for professionals? Is it A, to prioritize organizational profit over client interests, B, to act in the best interest of the client, C, to focus on minimizing risks for the lender, or D, to ensure the fastest loan approval process? The answer is B, to act in the best interest of the client. Fiduciary duty involves acting in the best interests of the client, requiring honesty, transparency, and prioritizing client needs above personal or organizational gain.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Disclosure and transparency obligations. Which of the following best describes the primary purpose of disclosure and transparency obligations in mortgage ethics? Is it A, to ensure clients are fully informed about mortgage terms, B, to comply with legal requirements only, C, to protect the interests of the mortgage lenders, or D, to simplify the mortgage application process? The answer is A, to ensure clients are fully informed about mortgage terms. Disclosure and transparency obligations are essential in mortgage ethics to ensure that clients are fully informed about the terms and conditions of their mortgage, enabling them to make well-informed decisions. What is a key ethical obligation when disclosing information to a mortgage client? Is it A, providing only the legally required information, B, ensuring the information is clear and comprehensive, C, offering information only when requested by the client, or D, disclosing information in technical terms to maintain accuracy? The answer is B, ensuring the information is clear and comprehensive. Ethical obligations in disclosure include providing information that is both clear and comprehensive, ensuring clients understand all aspects of their mortgage agreement. Why is it important for mortgage professionals to disclose potential conflicts of interest? Is it A, to fulfill legal obligations, B, to enhance the reputation of the mortgage firm, C, to prevent clients from making poor financial decisions, or D, to maintain trust and integrity in client relationships? The answer is D, to maintain trust and integrity in client relationships. Disclosing conflicts of interest is crucial to maintain trust and integrity in client relationships, ensuring clients are aware of any factors that might affect impartiality. How should mortgage professionals handle changes in terms that affect a client's mortgage agreement? Is it A, wait until the client inquires about changes? B, only disclose changes if legally required? C, promptly inform the client of any changes? Or D, update the client at the end of the fiscal year? The answer is C, promptly inform the client of any changes. Mortgage professionals must promptly inform clients of any changes to their agreement, ensuring transparency and allowing clients to make informed decisions regarding their mortgage. What is the ethical significance of providing clients with a clear breakdown of mortgage fees? Is it A, it ensures clients understand all costs involved? B, it simplifies the mortgage process for clients? C, it helps mortgage professionals meet sales targets? Or D, it fulfills a legal requirement for transparency? The answer is A, it ensures clients understand all costs involved. Providing a clear breakdown of fees is ethically significant, as it ensures clients understand all costs involved, fostering transparency and helping them make fully informed financial decisions. Unethical and prohibited practices. Misrepresentation and fraudulent behavior. Which of the following is considered a clear example of misrepresentation in mortgage applications? Is it A, providing accurate income details? B, inflating income figures to qualify for a larger loan? C, disclosing all existing debts? Or D, submitting all required documentation? The answer is B, inflating income figures to qualify for a larger loan. Misrepresentation occurs when incorrect or false information is provided intentionally to influence the mortgage approval process. It can lead to severe penalties, including loan denial and legal consequences. What is a common consequence of committing mortgage fraud? Is it A, legal prosecution and potential imprisonment? B, increased loan approval rates? C, higher interest rates on future loans? Or D, improved credit score? The answer is A, legal prosecution and potential imprisonment. Mortgage fraud can lead to severe legal consequences, including criminal charges, fines, and imprisonment. It undermines the integrity of the lending process and can damage credit ratings. How does falsifying property value in a mortgage application constitute fraud? Is it A, it ensures a quicker loan approval process? B, it results in lower interest rates? C, it allows for higher loan amounts? Or D, it misleads lenders about the collateral's true worth? The answer is D, it misleads lenders about the collateral's true worth. Falsifying property value is fraud, as it misleads lenders about the collateral's true worth, risking financial stability and integrity of the lending process. Such actions are strictly prohibited. What is the role of a straw buyer in mortgage fraud schemes? Is it A, to provide additional financial support? B, to increase the credibility of the borrower? C, to apply for a loan on behalf of another person? Or D, to reduce the interest rate of the loan? The answer is C, to apply for a loan on behalf of another person. A straw buyer is used to deceive lenders by applying for a loan on behalf of another person who may not qualify. This practice is unethical and illegal. Why is it unethical to omit liabilities on a mortgage application? Is it A, it misleads lenders about financial obligations? B, it speeds up the approval process? C, it reduces the total loan amount? Or D, it improves the applicant's credit score? The answer is A, it misleads lenders about financial obligations. Omitting liabilities misleads lenders about the applicant's financial situation, leading to potential loan approval under false pretenses. This is considered fraudulent and unethical.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Redlining, steering, and blockbusting. What is redlining in the context of real estate practices? Is it A, a practice of offering lower interest rates to certain groups? B, a strategy to increase property values in certain neighborhoods? C, refusing loans to people in certain areas based on racial composition? Or D, encouraging homeowners to sell by suggesting property values will decrease? The answer is C, refusing loans to people in certain areas based on racial composition. Redlining is a discriminatory practice where lenders refuse loans to people in specific geographic areas, often based on racial composition, violating fair housing laws. Which practice involves persuading homeowners to sell by suggesting that racial minorities are moving into the neighborhood? Is it A, redlining, B, steering, C, gentrification, or D, blockbusting? The answer is D, blockbusting. Blockbusting is a tactic used to instill fear in homeowners about declining property values due to racial integration, leading them to sell at lower prices. What is steering in real estate? Is it A, refusing to offer loans in specific neighborhoods? B, guiding buyers towards or away from neighborhoods based on race? C, encouraging sales by predicting future property value increases? Or D, offering different interest rates based on neighborhood demographics? The answer is B, guiding buyers towards or away from neighborhoods based on race. Steering occurs when real estate agents guide prospective buyers towards or away from certain neighborhoods based on race, violating fair housing laws. Which of the following is a consequence of redlining? Is it A, economic decline in certain neighborhoods? B, increased diversity in housing markets? C, higher property values in redlined areas? Or D, improved access to credit for minority groups? The answer is A, economic decline in certain neighborhoods. Redlining leads to economic decline in affected neighborhoods due to lack of investment, perpetuating poverty and poor living conditions. Which action is considered blockbusting? Is it A, denying loans based on neighborhood demographics? B, convincing homeowners to sell due to racial integration fears? C, directing clients to specific neighborhoods based on race? Or D, offering higher interest rates to minority buyers? The answer is B, convincing homeowners to sell due to racial integration fears. Blockbusting involves manipulating homeowners into selling by suggesting that racial minorities moving in will lower property values. Undue influence and conflicts of interest. What is considered an unethical practice when a mortgage broker attempts to influence a client's decision in their own favor? Is it A, providing multiple loan options? B, disclosing all fees up front? C, persuading clients to choose a specific lender for personal gain? Or D, advising clients to read the fine print? The answer is C, persuading clients to choose a specific lender for personal gain. Undue influence occurs when a broker uses their position to sway a client's decision for personal gain, compromising the client's best interests and violating ethical standards. Which scenario exemplifies a conflict of interest in mortgage lending? Is it A, a lender recommending a company they own shares in? B, a broker presenting unbiased loan comparisons? C, a lender offering a competitive interest rate? Or D, a broker refusing to work with a client? The answer is A, a lender recommending a company they own shares in. A conflict of interest arises when a lender has a personal stake in the outcome, such as owning shares in a company they recommend, compromising impartiality. How can a mortgage broker avoid undue influence when advising clients? Is it A, steering clients towards high-commission products? B, offering a comprehensive overview of all loan options? C, limiting information to simplify decision-making? Or D, recommending only preferred lenders? The answer is B, offering a comprehensive overview of all loan options. Providing clients with all available options and explaining each impartially ensures decisions are made based on the client's best interest, avoiding undue influence. What action should a mortgage broker take if they have a potential conflict of interest? Is it A, ignore the conflict and proceed as usual? B, advise clients to seek independent advice? C, attempt to resolve the conflict privately? Or D, disclose the conflict to the client immediately? The answer is D, disclose the conflict to the client immediately. Disclosing any potential conflicts of interest to clients ensures transparency and maintains trust, allowing clients to make informed decisions without bias. Which practice is prohibited to prevent conflicts of interest in mortgage lending? Is it A, offering discounts to clients? B, receiving kickbacks for referring clients to specific lenders? C, providing clients with lender ratings? Or D, discussing the pros and cons of different lenders? The answer is B, receiving kickbacks for referring clients to specific lenders. Accepting kickbacks from lenders for referrals is prohibited as it creates a conflict of interest, compromising the broker's ability to act in the client's best interest.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Ethics in advertising and marketing. Truth in advertising and trigger terms. Which of the following is considered a trigger term in advertising that requires additional disclosures? Is it A, low prices? B, monthly payment? C, best quality? Or D, limited time offer? The answer is B, monthly payment. Trigger terms are specific phrases in advertising that require additional disclosures under the Truth in Lending Act. Examples include monthly payment or interest rate, which necessitate further information about the loan terms. What is the primary ethical concern with using exaggerated claims in advertising? Is it A, they can mislead consumers? B, they are often humorous? C, they increase brand visibility? Or D, they are cost-effective? The answer is A, they can mislead consumers. Exaggerated claims can mislead consumers, violating ethical advertising standards. This practice can result in consumer distrust and potential legal consequences if the claims are deemed deceptive. Why is it important for advertisers to avoid using false endorsements? Is it A, they are costly to produce? B, they attract regulatory attention? C, they can deceive consumers? Or D, they are difficult to verify? The answer is C, they can deceive consumers. False endorsements can deceive consumers into believing a product has more credibility or effectiveness than it actually does, undermining trust and potentially leading to legal actions against the advertiser. What is the role of the Federal Trade Commission in regulating advertising practices? Is it A, to promote all advertising? B, to enforce laws against deceptive advertising? C, to create advertising content? Or D, to support marketing campaigns? The answer is B, to enforce laws against deceptive advertising. The FTC enforces laws to protect consumers from deceptive or unfair advertising practices. It ensures that advertisements are truthful and not misleading, maintaining consumer trust and fair competition. How do puffery claims differ from false advertising in terms of ethics? Is it A, puffery is more expensive? B, false advertising is always legal? C, puffery is based on facts? Or D, puffery is not meant to be taken literally? The answer is D, puffery is not meant to be taken literally. Puffery involves exaggerated claims that are subjective and not meant to be taken literally, thus not considered deceptive. False advertising involves objectively false claims that can mislead consumers and are unethical. Anti-steering rules and loan suitability. What is the primary goal of anti-steering rules in mortgage lending? Is it A, to maximize lender profits? B, to simplify the loan application process? C, to prevent consumers from being directed to unsuitable loans? Or D, to eliminate all loan fees? The answer is C, to prevent consumers from being directed to unsuitable loans. Anti-steering rules aim to protect consumers from being pushed towards loans that benefit the lender but may not be in the consumer's best interest. These rules ensure transparency and suitability. Which of the following is a requirement under the anti-steering rules? Is it A, offer loan options with the lowest interest rate and lowest points? B, recommend loans based solely on the lender's incentives? C, provide only fixed-rate loan options? Or D, ensure all loans have no closing costs? The answer is A, offer loan options with the lowest interest rate and lowest points. Lenders must provide loan options that include the lowest interest rate and lowest points for which the consumer qualifies, ensuring choices that are in the consumer's best interest. How do anti-steering rules impact the role of mortgage loan originators? Is it A, they can offer any loan that maximizes their commission? B, they must provide a range of suitable loan options to borrowers? C, they are no longer needed in the loan process? Or D, they should only focus on loans with adjustable rates? The answer is B, they must provide a range of suitable loan options to borrowers. Mortgage loan originators must prioritize the borrower's best interest by offering suitable loan options, which may require them to change their approach to customer service and loan recommendations. What is one potential consequence for lenders who fail to comply with anti-steering rules? Is it A, increased customer satisfaction? B, higher loan approval rates? C, more flexible lending terms? Or D, regulatory penalties and fines? The answer is D, regulatory penalties and fines. Non-compliance can lead to regulatory penalties, including fines and legal action, which underscores the importance of adhering to these consumer protection standards. Why is loan suitability important in the context of anti-steering rules? Is it A, it ensures borrowers receive loans that meet their financial needs? B, it guarantees the lowest possible interest rate? C, it focuses solely on maximizing lender profits? Or D, it eliminates the need for credit checks? The answer is A, it ensures borrowers receive loans that meet their financial needs. Loan suitability ensures that borrowers receive loans that match their financial needs and capabilities, preventing financial distress and promoting responsible lending practices.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Consumer protection and regulatory compliance. Equal credit opportunity and fair lending. Which of the following is a key requirement of the Equal Credit Opportunity Act? Is it A, creditors must provide notice of action taken within 30 days? B, creditors must offer the lowest possible interest rate? C, creditors must approve all applications within 60 days? Or D, creditors must provide free credit counseling? The answer is A, creditors must provide notice of action taken within 30 days. The ECOA requires creditors to provide applicants with a notice of action taken, which includes the reasons for any adverse action, within 30 days of receiving a complete application. What is the primary purpose of the fair lending laws? Is it A, to ensure all loans are approved regardless of creditworthiness? B, to require lenders to offer identical terms to all applicants? C, to prevent discrimination based on personal characteristics? Or D, to mandate a fixed interest rate for all borrowers? The answer is C, to prevent discrimination based on personal characteristics. Fair lending laws aim to prohibit discrimination in lending based on race, color, religion, national origin, sex, marital status, or age, ensuring equal access to credit. Under the ECOA, which of the following is considered a prohibited basis for discrimination? Is it A, credit score, B, marital status, C, employment history, or D, loan amount? The answer is B, marital status. The ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. What does the term adverse action refer to under the ECOA? Is it A, denial of credit or changes in credit terms, B, approval of a loan with high interest rates, C, offering credit with a longer repayment term, or D, providing a credit limit increase? The answer is A, denial of credit or changes in credit terms. An adverse action under the ECOA includes denial of credit, a change in terms of an existing credit arrangement, or a refusal to increase the amount of credit available. How does the Fair Housing Act relate to fair lending practices? Is it A, it mandates equal housing prices for all, B, it requires lenders to offer loans to all applicants, C, it standardizes interest rates across all lenders, or D, it prohibits discrimination in housing-related transactions? The answer is D, it prohibits discrimination in housing-related transactions. The Fair Housing Act prohibits discrimination in housing-related transactions, including mortgage lending, based on race, color, religion, sex, disability, familial status, or national origin. Responding to complaints and ethical reporting. What is the first step a mortgage company should take when receiving a consumer complaint? Is it A, resolve the complaint immediately, B, ignore the complaint if it seems trivial, C, acknowledge receipt of the complaint, or D, forward the complaint to a third-party agency? The answer is C, acknowledge receipt of the complaint. Acknowledging receipt of a complaint is essential as it shows the consumer that their issue is being taken seriously. It also helps establish a timeline for resolution. Which of the following is a key element of ethical reporting in consumer protection? Is it A, transparency, B, omitting negative feedback, C, delaying report submissions, or D, using complex jargon? The answer is A, transparency. Transparency ensures that all stakeholders have a clear understanding of the company's practices and the steps taken to resolve issues, which builds trust and accountability. How should a mortgage company handle a complaint that involves potential regulatory non-compliance? Is it A, ignore the complaint, B, resolve it internally without further review, C, offer compensation immediately, or D, escalate to the compliance department? The answer is D, escalate to the compliance department. Escalating to the compliance department ensures that experts in regulatory matters can assess and address the issue appropriately, minimizing legal risks and ensuring compliance. What is an important consideration when documenting a consumer complaint? Is it A, use vague language to avoid liability, B, ensure accuracy and detail, C, exclude customer contact information, or D, document only resolved complaints? The answer is B. Ensure accuracy and detail. Accurate and detailed documentation is crucial for understanding the issue, ensuring a thorough investigation, and providing evidence in case of regulatory reviews. What is a potential consequence of failing to address consumer complaints ethically? Is it A. Increased consumer trust, B. Improved customer satisfaction, C. Regulatory penalties, or D. Enhanced company reputation? The answer is C. Regulatory penalties. Regulatory penalties can include fines and sanctions, which can have significant financial and reputational impacts on a company, emphasizing the importance of ethical complaint handling.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.